Hi, welcome to Slay the Spider. I'm Jim B, and I'm the creator and host of Slay the Spider. Shares of the S&P 500 are called S&P Depository Receipts, SPDRs. Spiders. Slay the Spider means I intend to beat the S&P 500 quite substantially. There are three major influences on the movement of stock price, according to a study by Ben E. King. 80% of your investment success will be due to the movement of the sector and the market. Now you can view a weekly snapshot image of the market and the sectors. This is a snapshot from April 9th, 2021. The red arrow, pointing towards the 2 o'clock position, represents the market. The rectangles each represent a mini-sector. They are color-coded to the sector they represent. Healthcare mini-sectors are in red, technology is dark blue, financials are green, media communications are brown, industrials are purple, consumer discretionary are light blue, and all the others are gray. I've been charting this movement since 1998 over more than 25 cycles using this exact mix of 40 mini-sectors. The key to understanding the movement and what makes the cycle predictable are the psychological stages that investors experience as they go through complete market cycles. It rarely changes. These stages are on the outside border of the circle. The placement of the sectors and the market are completely data-driven. The interpretation of what to expect next is from my experience of going through the cycle dozens of times. I'm not always perfect, but the beauty of the circle is that it corrects me quickly when I don't get my prediction absolutely correct. I've learned it's okay to be wrong now and then, but absolutely abysmal to stay wrong when the data says otherwise. Weekly movement in the sectors this week were very negative because we were down 4 out of 5 days. First, in the health sector, biomedical advanced, healthcare declined, and drugs advanced. In media communications, internet stocks declined, media declined, and telephones were unchanged. In technology, semiconductors declined, computers declined, electronics declined, and software declined. In consumer discretionary stocks, autos declined, gaming declined, leisure declined, restaurants declined, household products declined, and retail declined. In financials, banks declined, Wall Street declined, savings and loans declined, real estate declined, insurance advanced, and financials declined. In the industrials, building products declined and crossed to the bear side. Chemicals were unchanged, aero defense were unchanged, steel advanced, machinery tools declined, metals declined, and waste declined. In the others, forest products declined, textiles declined, food advanced, protection and safety declined, precious metals declined, transports declined, oil services declined, business products declined, gas utilities rose, electric utilities rose, and oil declined. This week, 3 sectors were unchanged, 6 sectors advanced, 31 sectors declined, 1 sector crossed to the bear side, none crossed to the bull side. There are now 10 sectors on the bull side and 30 on the bear side. Overall, the market score declined from 34 to 28. For the week ending December 17th, the S&P 500 was down 91 points or 1.9%. The Dow Jones Industrial Average was down 605 points or 1.68%. NASDAQ was down 460 points or 2.95%. This week we had 180 stocks go from buy signals to sell signals. We had 15 new issues. We currently have 2,360 stocks on buys and 4,159 on sell signals. Overall, the market score last week was 34. This week, it's 28. In last week's newsletter, I stated I thought we might be seeing a down leg of the 4 o'clock loop beginning. I now believe it has begun. The down leg is a 7 to 10 day series of down days, often with one up day somewhere in the middle. This past week, we had 4 or 5 days down, with Wednesday the exception. I expect this down leg to last through Thursday. Why? For several reasons. First, the markets are closed on Friday and only open half day on Thursday, closing at 1 p.m. Eastern Standard Time. Traders don't like the idea of being in long positions over a long weekend, especially during volatile periods in the markets. I expect a significant sell-off in stocks Wednesday afternoon and Thursday morning after down days Monday and Tuesday. Second, Biden is expected to announce stricter COVID protocols on Tuesday due to the Omicron variant spreading rapidly. Third, China Evergrande is now officially in default, thus triggering cross-default bond provisions, and the repercussions are spreading in the financial sector. I don't expect this to have major effect, but it's a factor this week. Fourth, we saw high-yield bonds give a second sell signal this past week, and a third sell signal is not that far away on the charts. That could easily happen by Wednesday. Fifth, 10-year Treasury yields have dropped from 1.525% to below 1.422% this past week, indicating a flight to safety may already be underway. Fed Chairman Jerome Powell enabled this by indicating the Fed funds rate will not rise until June. Sixth, central banks all over the world are raising rates to fight inflation. All over the world except for in the U.S. And I think there's a general consensus that the U.S. should be raising rates to fight inflation. In short, investors and the markets need to signal to the Fed their plan is both dangerous and not working. I expect by Thursday we will have had 8 of 9 consecutive days of down markets, the only up day being after the Fed announcement on Wednesday earlier this week, resulting in a 2-hour rally up. Of course, I'm not 100% certain we will have 4 more consecutive down days. One never knows what the news cycle will bring. The actions that I'm taking is that I'm buying S&P 500 SPY put option contracts on Monday morning. These contracts will be 3 to 5 points below the then current price. For example, the SPY is currently at 460, so I would be buying the strike price of 455 to 457 if the SPY were still at 460 on Monday morning. Adjust accordingly to what the price of the SPY is. I will be buying the Thursday, December 23rd expiration contracts. Assuming the markets do move down this week, I will double up with each opportunity. I also plan to take money off the table to recoup my initial investment. That way, I will have no personal risk of loss once recouping my initial cost. I intend to keep doubling down as often as possible through Wednesday, and it's my intent to hold in-the-money options at the market close on Wednesday.